Food prices push Nigeria's headline inflation higher to 18.48% in November. Meantime, Namibia's inflation unchanged at 7.3% last month as the country's economy shrinks by 1% in third quarter. Plus, global markets mixed on Thursday. FOMC market reaction to the Federal Reserve interest rate hike. Good afternoon, welcome to the program. I am Bosin Amafaye here at Channel's headquarters in Lagos. We'll start from Nigeria, where the headline inflation released today kept 0.15% higher in the month of November to 18.48%. That comes against the October level of 18.33%. In a report released Thursday, the Statistics Office says the increase was due largely to higher prices of food items and energy. The food sub-index came in at 17.19%. Last month, Nigeria's urban inflation hit 20.07% for the first time ever, while the rural inflation index also climbed higher to 17.10%. Although both urban and rural inflations trended slightly lower on a month-on-month basis, the figures were higher on annualized basis. Now, it's been 24 hours since Nigeria's President Muhammadu Buhari presented a 7.298 trillion naira, or about $24 billion 2017 budget to the National Assembly. The budget looks to grow and stabilize the flagging economy of Africa's most populous country. It is currently in recession. Joining us via Skype from London at this time is Gamin Noyane, a senior macroeconomic specialist at Ecobank International. Welcome to the program, Gamin. It's good to see you.
Hi. Thank you.
Thank you. So what do you make of the overall 2017 budget package by the Buhari's administration?
Well, I think it is a positive step. 7.3 trillion, that's a lot of money, and it's expansionary. It's 20% above the 2016 budget, which is good for an economy like Nigeria going through a recession at the moment. It needs an expansionary budget to help to stimulate economic activity. But I think that it's fraught with a lot of risk. Based on the assumptions underlying the budget. We've seen that the government expects the oil price benchmark to be $42.5 dollars, which is good because we're expecting oil prices to be just above $50 a barrel. But in terms of the oil production and exchange rate assumptions, I think those are a bit unrealistic.
Yes, Gamin. So, from a global perspective, what are the key issues for you? Sitting outside there in London, looking into Nigeria, listening to international investors, portfolio, foreign direct investors, trading the currencies, what are the key issues here?
Well, of course, the major issue remains the exchange rate policy. It remains the continued liquidity in the markets. The confidence has actually dropped significantly since the central bank decided to adopt the more flexible exchange rate policy. There was a lot of hope that this will help to resolve all the imbalances with regards to the exchange rates. But we've seen that the currency has actually depreciated rapidly. We've seen that the currency it's operating in a highly fragmented market. We're having about 10 various exchange rates, depending on what you want to use it for. So in that case, it shows that there's major distortion in the exchange rate markets, and further devaluation is needed.
Gamin, what are the chief concerns about Nigeria's overall economic recovery and growth, and not just for 2017 fiscal year, but beyond 2017? What do you like to see?
Well, I think I would like to see more clear policy direction from the CBN with regards to the exchange rates policy. I think that is a critical issue because if Nigeria can overcome that, I think we'll see a lot of investors deciding to park their money in NGN denominated assets, because at the moment investors are adopting a wait and see approach, scaling back, because they're not sure about what the policy direction is. So there's a lot of uncertainty there. And Nigeria, it's a very big market. So in terms of operating there, once the government decides to overcome this hurdle, will provide real returns for any investor. But until then, until we see significant increase in oil production, in oil prices, in the policy direction of the exchange rates, we're unlikely to see any major recovery in the Nigerian economy.
Gami Nonyane, we'll be checking with you from time to time. Thank you for your time this afternoon. Go back and have your lunch if you haven't had it. Thank you so much from EcoBank International in London. Gami Nonyane, a senior macroeconomic specialist there speaking to us. Let's cross over to Europe. Of course, we'll have a little bit more to chew about Nigeria's budgets and those parameters, in particular, the oil price benchmark and the output assumptions. European stock markets were mixed at the opening bell today after the U.S. Federal Reserve announced a 25 basis point hike in the Fed fund rate, keeping the door open for 3 more hikes in 2017. Traders also have their eyes on Bank of England's interest rate decision today from Makani. Let's get some perspectives into this and other headline stories from Frankfurt Stock Exchange, where Conrad Boston of DW TV4 Channel Television is standing by for us. Good afternoon, Conrad, and welcome to the program. This is what you call the morning after. U.S. FOMC raising rates, but how are the markets digesting the hint that at least 3 other rate hikes lie ahead in 2017?
Well, Bosun, check out what the German stock index, the DAX, is doing. It's nicely on the rise, as you can see right behind me. So people, investors here in Germany, are putting the positive implications of this in the foreground. Positive implications, for example, for the banks. Deutsche Bank, Commerzbank, those 2 shares are the biggest DAX gainers today. Of course, the low interest rate environment that we for a long time now had put under pressure traditional banks and their traditional business models, to pay people something that bring their savings to the banks. So the perspective that soon interest rates are rising in the US and also the general interest rate level will come back into positive territory is good news for the banks and also, of course, for people who want to save money. The average yield on Germany's 10-year government bonds also is on the rise. It jumped upwards to 0.3% today. Remember, most of this summer, this yield was down in negative territory. The euro has come significantly down after Yellen's press conference. It's currently trading nearly 2 US cents lower than yesterday at lunchtime. Of course, a cheap euro is positive for our exporting industries here in Germany that become more that get more competitive with a lower euro. Other market reactions worldwide haven't been so positive. Australia, for example, and many stock markets in Asia traded lower today. We talked about it yesterday, Bosun. Of course, if interest rates are going to rise in the United States, this could eventually mean that investors pull their money out of, for example, many emerging economies and repatriate it to the United States. So that's a preoccupation in those parts of the world.
Yes, Conrad, part of what you've just said relates to the key economic data out of Eurozone today. The manufacturing and sales managers index alongside the BOE's interest rate decision, where the euro are going slowly, taking the 3-day hit against the US dollar pre-FOMC, post-FOMC. So talk us through this, Conrad.
Well, let's start off with the Bank of England's decision to leave the interest rates where they were before at a record level of 0.25%. That was widely expected on the markets, but more and more people I talk to here are convinced that soon the Bank of England should raise interest rates. The economy in the UK has been doing relatively well. Inflation is up. So the picture book reaction by monetary policy makers in the UK should be to raise rates. Of course, recently the Bank of England's chief, Mark Carney, had indicated that he would live maybe a bit longer with higher inflation rates, given that there still are negative implications and negative effects of the Brexit negotiations expected on the UK economy. Here in the Eurozone, the data coming from the Market Institute, which regularly calculates a purchasing managers index, has been coming in quite strong. 53.9 points is the reading of this index. Everything above 50 indicates growth. On the other hand, the real GDP numbers here in the Eurozone, as well as inflation, are not very solid yet, so we shouldn't expect that the European Central Bank takes this purchasing managers index from the Eurozone too seriously or too much as a sign that it should start raising rates or tightening its monetary policy soon.
Yes, Conrad, again, you alluded to the banking shares moving today across the European markets, but again, the banking system keep flashing on the radar. The talks of new tougher capital regulations are nearly $300 billion required by banks to buffer any likely impact of failure of their failure on the taxpayers across the region. What's the latest on this?
Well, the latest rumors, and I have to stress, all I can give you here is coming straight out of the rumor mill, it hasn't been confirmed yet, is that the banks in Europe can hope for less strict capital requirements in future. You know, at the moment in the Swiss city of Basel, the so-called Basel Committee sits together to decide and to negotiate what the future worldwide rules for the banking sector should be. In this Basel Committee, banking supervisors and central banks from 26 countries come together in order to work out the set of rules that the banking sector should follow worldwide. And until recently, the rumor mill said that the new rules would become much stricter than they are now. But there had been afterwards after those rumors, strong opposition from many Eurozone countries. No surprise, that is, given the weak capital situation of many European banks. But also, Donald Trump in the United States is said to be not so keen on too strict rules for the banking sector. All this combines makes banks hope that they will be, let off the hook, if you like, and that they will not have to follow too overtly strict capital requirement rules that they cannot, follow.
Well, Conrad, I think we're around Basel III now. So I think we're in the Basel III, just about 10, 15 years ago. With the Basel I, they got a Basel II, then you have the third one now. So looks like perhaps we're going to get another Basel anytime soon. Those folks in Brussels in Switzerland seems to be really pretty busy. Conrad, do have a great day. See you tomorrow, Friday. Let's wrap up the market week. Let's get back to the continent where the market is trading. Nigerian stock market really strong in today, Thursday, holding on to earlier gains in the week. We're about 0.5% at about an hour ago on the NSE Broad Index. That's 26,514.61. Look at the South African market, a little bit quiet, flat as it were, at about 12:30 South African time, 15,796. It's been a very tepid year for the largest market on the African continent. The Egyptian market still looking for direction, less than 0.1%. And the Kenyan Stock Exchange, that was Wednesday close, 131.63 reading on the Nairobi Stock Exchange Index. Cross over to the Middle East quickly and look at the markets there in gentle recovery led by the Saudis market. The Tadawul market, 7,041, up about 0.2% in afternoon trade. Look at the Abu Dhabi market, negative about 0.25%. The Dubai financial markets, a little bit also negative 0.81%, and the Qatar market, 10,251, about 1% in the red. Wall Street market. But let's talk about Asia. First, mostly lower today as the dollar rose sharply and investors digest the latest Federal Reserve's first interest rate hike this year and the hawkish outlook for the 2017 incoming year. The Australian ASX 200 was down about 1%. The Nikkei 225 about 0.1%. The mainland Chinese market lower. The Shanghai Composite closed down 0.71%, while the Shenzhen Composite was 0.66%. The Hong Kong Hang Seng tumbled 1.87% early today. Of course, we're early morning hours on Wall Street. Stock futures pointing to a flat open as everyone chew over yesterday's interest rate decisions. We'll be back after the break.